Welcome to vTalkInsight, Risk Sentiment Daily for December 10th, 2025. Global markets are wrestling with rising bond yields, a pivotal Federal Reserve meeting, and an AI-driven growth story that refuses to fade. Let us look at how that tug-of-war is shaping risk appetite today. Risk sentiment today sits in a cautiously balanced zone, with neither outright risk-on nor full risk-off dominating. Index levels remain close to recent highs, but the tone has shifted as bond markets push back against the idea of rapid Federal Reserve easing. In recent days, United States Treasury yields have moved to multi-month highs, and global sovereign curves have followed. Markets that, earlier this week, were comfortable with a fairly generous path of cuts now price only a limited easing cycle, with skepticism especially visible at the long end of the curve. Equities are reflecting that tension. The S&P 500 has slipped off its peak and volumes are running below the recent average, suggesting investors are in a holding pattern ahead of the Fed decision and key data later this month. At the same time, several powerful supports remain in place. Structural AI-driven growth, a broadening equity rally beyond mega-cap technology, and still solid labor and consumer data keep the medium-term backdrop constructive, even as higher yields and policy uncertainty narrow the margin for error. A key bearish force right now is higher for longer yields and a hawkish-leaning Federal Reserve narrative. United States Treasury yields have climbed to multi-month highs, and the two-year yield has reached a 10-week high, echoing a broader rise in global bond yields. This move reflects a sharp repricing of the easing path. Front-end markets that once expected roughly 150 basis points of cuts from the Fed by 2026 now look for only about half that, and pricing for the coming year has shifted from 3 cuts to closer to 2. The upcoming Fed meeting is central to this story. A rate cut is widely expected, but the messaging is likely to stress that policy is moving toward a neutral range and that the bar for additional easing is high, especially with inflation still above target and showing signs of persistence. Many investors now believe that even with a cut, 10-year Treasury yields could drift higher, driven by sticky inflation expectations, fiscal expansion, and global central banks leaning more hawkish. That combination has already cooled equity risk appetite, ending the recent winning streak in the S&P 500 and weighing on rate-sensitive assets. Looking ahead, the bigger catalysts may be incoming data and Fed communication rather than the single decision itself. November inflation and payrolls data later this month are expected to be highly influential for the policy path, while potential dissent within the FOMC and the updated projections could reinforce the higher for longer message or, if surprisingly dovish, ease some of this pressure. Overlaying the rate story is growing concern about valuations, leverage, and market fragility. Options markets show that the cost of downside protection has fallen to around the 30th to 40th percentile of historical levels, indicating that investors are paying relatively little for hedges even as macro risks build. At the same time, elevated single-stock call volumes and high-margin debt point to substantial speculative positioning in equities, with relatively low institutional participation. That mix can create an unstable structure where crowded trades and leveraged positions are vulnerable to sharp reversals on any negative surprise. Credit markets add another layer of fragility. Spreads are compressed, offering limited compensation for taking additional credit risk, and there are worries that inflated ratings in private credit may be masking underlying vulnerabilities, echoing dynamics seen before earlier crises. In the AI ecosystem, heavy infrastructure spending is not always matched by revenue, raising questions about future margins and the sustainability of some valuations. Large acquisition financing, such as talk of tens of billions in bridge loans and media and technology deals, also lifts leverage and increases sensitivity to any tightening in funding conditions. Put together, rich valuations, light hedging, and leverage mean that markets are priced for a smooth outcome, with limited room for upside and growing downside convexity. A hawkish surprise from the Fed, a growth disappointment, or a regulatory shock could trigger outsized moves, particularly in the most speculative corners of technology and crypto, which have increasingly acted as barometers of risk-off sentiment. A third bearish driver is the interplay between liquidity, credit, and policy stress. Upward pressure on the effective federal funds rate and narrowing spreads to the interest paid on reserves suggest that system liquidity is tightening, prompting discussion that the Fed may soon need to expand its securities holdings. The concern is not just whether the Fed adds liquidity, but whether it adds enough. Some fear that if upcoming operations are too modest, funding conditions could remain strained, with higher repo rates already increasing costs for leveraged positions in large-cap technology and contributing to recent drawdowns. Outside public markets, private credit and real estate are key watchpoints. Regulators are being pushed to stress-test private credit after a string of bankruptcies, and there is a sense that policymakers are less willing to provide backstops, even as institutional allocations to the asset class keep rising. Policy uncertainty further complicates the picture. Potential legal changes that could weaken the independence of agencies such as the Fed, threats of new tariffs on key agricultural imports, and intensified European antitrust scrutiny of major technology platforms all inject additional risk premia into markets. This combination of tighter liquidity, opaque credit risk, and unpredictable policy raises the odds that any negative shock could propagate quickly through funding markets and into risk assets. For investors, it means that monitoring plumbing indicators and regulatory headlines is as important as reading the next central bank statement. On the positive side, AI-led structural growth and earnings remain a powerful bullish anchor for risk sentiment. The theme is increasingly framed not as a speculative bubble, but as a multi-year investment cycle that is reshaping business models, capital spending, and sector leadership. Recent numbers illustrate the scale of this shift. One leading AI firm has seen annualized enterprise revenue jump from about $1 billion to $10 billion in a year, with the bulk coming from coding and productivity use cases, while forecasts suggest that by the end of 2025, most companies will have deployed at least one AI product. The infrastructure response is equally significant. Large asset managers and sovereign investors are launching multi-billion-dollar initiatives targeting AI data centers, while industrial companies are pivoting to supply gigawatts of power turbines to meet an expected 2 to 5% annual rise in electricity demand over the next 2 decades. Policy shifts are also unlocking new revenue pools. United States authorities have allowed sales of advanced but not cutting-edge AI chips into China, with some estimates suggesting this could reopen a tens of billions of dollars market for a key semiconductor name, even after accounting for profit givebacks and regulatory uncertainty. For markets, this AI boom underpins expectations of strong earnings growth and supports higher multiples in parts of technology, industrials, and utilities tied to data center and power demand. At the same time, not all spending is yet justified by revenue, so dispersion between AI execution winners and overextended stories is likely to remain a defining feature of equity performance. Another constructive driver is the broadening of equity leadership beyond mega-cap technology. Whereas earlier this year gains were heavily concentrated in a handful of AI-exposed names, recent performance has shown stronger participation from cyclicals, financials, and several non-United States markets. Investors report that markets such as Spain, Chile, and South Africa are now outperforming United States tech-heavy indices, and sectors like industrials, healthcare, and utilities are drawing more capital. This points to greater confidence in the underlying global growth outlook, rather than a narrow bet on one theme. Within sectors, financials and defense stand out. A significant share of recent intraday highs in the S&P 500 has come from financials, supported by regulatory relief and robust fundamentals, while European defense stocks have rallied on the back of record German procurement plans and potential new funding mechanisms for Ukraine. Energy names and travel-related companies are also benefiting from strong demand and sector-specific momentum, even if commodity prices have softened at the margin. In private markets, deal activity has rebounded sharply and private equity secondaries are at record size, indicating renewed confidence in exit options and valuations. This broadening leadership matters because it reduces reliance on a single group of mega-cap stocks and creates more avenues for diversification across regions and sectors. The caveat is that dispersion is high, with select retailers and basic resources names flashing weakness, so security and sector selection remain crucial even within a generally constructive equity backdrop. The third bullish force is resilient labor markets and consumer demand, which continue to support a soft landing narrative. United States job openings recently beat expectations by a wide margin, and a cluster of indicators from job postings to small business surveys suggest that employment conditions have stabilized or improved compared with earlier in the year. Some analysts argue that the labor market may have already bottomed back in April, with payrolls and layoffs inflecting since then. More recent data show the first positive job growth after several weeks of declines, with small businesses, which had been under the most pressure, contributing meaningfully to hiring. On the demand side, consumer spending looks stronger than the cautious headlines might imply. Forecasts point to around $1 trillion in holiday sales, with average family spending at a multi-decade high, and travel data show record numbers of passengers moving through airports, supporting airlines, cruise lines, and hotels. There is, however, a clear bifurcation beneath the surface. Higher-income households appear resilient and are even trading up in some cases, while lower-income consumers remain under pressure, displaying acute price sensitivity and favoring discounts on essentials over discretionary items. For markets, resilient employment and consumption help justify expectations of continued growth, even as monetary policy tightens, and they offer support to sectors tied to travel, experiences, and everyday services. The flip side is that this strength can also keep inflation sticky, reinforcing the higher-for-longer rates narrative that complicates the overall risk picture. To sum up, today's risk sentiment is defined by a tug-of-war between higher-for-longer yields, stretched positioning, and pockets of policy and credit stress on one side, and a durable AI-driven growth story, broader equity leadership, and resilient labor and consumer fundamentals on the other. Markets are no longer priced for a carefree easing cycle, but they are also not capitulating on the soft landing or structural growth narratives. Key watch points from here include the Fed's tone around this week's cut, any signs that long-dated yields are breaking higher again, incoming inflation and payrolls data, the evolution of liquidity operations, and evidence of real AI monetization in earnings. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.